All right, guys, I see our first guest hopped in backstage, Mr. Rod Alzmann. Without further ado, it's been too long since we've had Rod on the show. I think since last summer, actually, but I'm sure he's been getting a lot of reach outs, media requests right now. 2-year anniversary, basically, of when everything went down. So let's give Rod our special Zinger Nation welcome and catch up when we come back. Sorry about that. Mr. Rod, how are you doing today?
Hey, good morning, Aaron. How are you doing?
I'm good. So have there been people reaching out basically being like, it's been 2 years since GameStop, we want to chat?
No, it's funny
Really?
you say that. Not for me, at least. I'm sure Roaring Kitty gets his requests that he's been ignoring. I'm sure those are piling up for him, but not for me. That was fun. I was on with you guys a few times 2 Januaries ago, and felt like every time you guys had me on, all these halts kept happening. It was crazy. It was mania.
Hey, shh. We don't want to be, we're just a room where it happened. We obviously, whatever. We did get a clip from Benzinga. Well, it was called Power Hour at the time, turned into Benzinga Live. A clip of that was on the Netflix documentary. Did you get any FaceTime on there?
I participated in one documentary. It was the one that they put out. It's on Hulu right now, Rise of the Players. So that was a bunch of many of the people who were participated in that documentary were part of the Roaring Kitty chats back in early 2020 before it went haywire, summer 2020. So that was my one that I agreed to do. I did have to deal with an expensive investigation. It's costly to deal with complying with subpoenas from our 3-letter agencies. So fortunately for me, that's all in the tail view. Working on things with Wook Capital Management now. So having good times over here, but hopefully no more crazy manias that cause me to deal with the feds.
Yeah, and I want to, obviously GameStop, like, is that for you a closed book? Like, is that chapter over? Are you still holding shares? What's the deal?
Yeah, I have no position in the company. I think their prospective transformation has been a little bit disappointing to date. They've dealt with the challenges of this console cycle kind of being in fits and starts where the software launches at the onset of the cycle weren't as impressive as they could have been ex-COVID. There's a lot of exciting games coming out in 2023, but just it gets back to valuation for me. It was a compelling deep value, DFV, if you will, in 2019, 2020 when it traded in the, I guess, split adjusted. Now it traded around a buck split adjusted. And I was an aggressive buyer at those levels, but now it's clearly, many 10, 20x times the valuation today. And the reality is the income statement still doesn't reflect that transformative improvement. They're still on an operating basis losing money. There's obviously a very passionate investor base, and they tapped them to at the market offerings. That's really revamped the balance sheet from where it was in the beginning of 2021 to where it is now. They have no issues from a solvency perspective, but it's just a valuation thing. They would need their EBITDA to get back toward record levels in the early 2010s before digital really took share in the physical from physical games. So that's kind of where I'm at. We still monitor it though. Every time they have a quarterly call, we've been hosting those calls on the Wook Capital Management Twitter, just because we know a lot of our folks who are familiar with us are interested in following what's going on. So I'll share my perspectives on what's going on with the income statement, with gross margins, with all that stuff. I'm well aware of it. I think I might have told you guys when you had me on in before all the craziness that it was the first stock I ever bought when I was in my mid-teens in the early 2000s. So it has a special place in my heart. I'll always be interested in what happens with it, but just because you like a business or you like a stock doesn't make a compelling investment opportunity.
Got it. Jay Rice in the chat's asking if you ever got short GameStop.
I have most of my assets in IRAs after the whole GameStop craze. So you can't short stocks in IRAs. Regarding Wook Capital, we've been opportunistic throughout the past year. So Wook began as a direct byproduct of GameStop. John Kim, the chief investment officer and founder of Wook Capital, and I met during 2020 digitally. We were both very interested in GameStop. So John had been one of the largest individual shareholders in GameStop before exiting in the north of the $300 per share range during the mania. And the capital that he accumulated as a byproduct of that has become Wook Capital Management. So memes like GameStop, when the implied volatility goes haywire and when they get those crazy spikes, whether it's short covering, whether it's a resurgence of retail interest, I think year to date, it's a combination of those two things. Whether it's GME, whether it's BBBY, any meme, if we think that there's an opportunistic risk reward from the fund's perspective, we'll sell naked calls. We have the balance sheet that we can absorb the position moving against us meaningfully. And that's been a major contributor to performance for 2022. We ended the year up as a fund, just breaching into the positive double digits. And year to date, we're actually up about a comparable amount, into the low double digits. So we've had a great run considering what the market's done over that period of time. And yes, it does involve opportunistically deciding to sell lottery tickets to the memers if the risk reward is attractive. But yeah, that answers the question.
It does. And Rod, I appreciate the transparency, and I'm sure Jay does, and the rest of the audience as well. Rod, unfortunately, so I have another interview at noon, and they've got a hard stop at 12:15. I'm not cutting us off now. I'm just saying, I want to get way more into what you guys are doing at Wook Capital and everything. I just worry that, in 5 minutes we might not get to all that. So I just want to do some rapid fire questions here, but we get you on again soon so we can get more in depth into what you guys are doing at Wook. So a few things I'm curious about, and again, try to go quickly here. So when you and I'll include you and Rory and Kitty kind of in the same breath, first found GameStop, whatever, before everything. I mean, it was kind of, you guys were both kind of looking at that intrinsic, deep value in it, kind of in the same perspective. Is that correct?
I think we were thinking about it fairly similarly. Yeah. For both of us, it seems, I had a couple one-on-one talks with him. I haven't spoken with him since everything happened, 2 years ago. But at the time, my sense was that his view was that the core foundational elements, the operating business, could generate much more cash than it was. It was the tail of the last cycle. I think we all thought the business would improve from the next cycle coming upon us. There was the element and the awareness and the cognizance of there being a supremely large short interest, partially as a byproduct of George Sherman, the prior CEO's buybacks that he began to act upon in early 2019 when he was hired. Actually, on my birthday, 2019, he did 2 rounds of buybacks, which slashed shares outstanding meaningfully, and that's why you got to a short interest that became eventually 140% of the float back then. And that was a secondary consideration, but it was something that it was a curiosity, and clearly it played out beyond our expectations. But at its core, I think, like Keith, there's a fundamental reason this business should and can exist and be profitable. And that question still is outstanding. There's still folks who think it shouldn't exist, and there's still folks who, like me, who think it should, just that the valuation is not attractive.
Got it. Yeah, and that's what I think. What that leads me to, wonder today now is and I'm sure when we get more into what you guys are doing at Wook Capital, we can talk about it, but are there any, deep values names like that right now? I've been looking at some of these department stores, Macy's, for example, the market cap's $6 billion. And if you just look at how much, it says right here, enterprise value, $12 billion. So if the company's, if the market cap's half of what the enterprise value is, and then you look at its total assets, the company's total debt, there seems to be some sort of misalignment there, as if the market's pricing in Macy's to go out of business or something. And it's all right, do I think that's going to happen? Is that the right way to look at it? What do you think?
Retail is really interesting right now. And I think you're right that there could be some diamonds in the rough that aren't going to walk away on the other side of where we are. out of the soft landing, the recession, whatever it is that we come into in the back half of this year or throughout this year. Retail, the thing you need to really be cognizant of with retail, though, is how much most of them over-earned during COVID. If you look at, for example, like gross margins for a lot of these retailers, look at, if you want to see a crazy chart, look at Dillard's, look at DDS. Dillard's is just been an absolute beast. Absolute
yeah, I had no
beast.
clue.
I have no
why is Dillard's doing so well?
But all Dillard's is, right? All Dillard's is it's a department store. It's a Macy's-esque, maybe it's a little more upscale, I guess. It's the Sun Belt. It has a better geographic base than.
But look at Nordstrom compared to Dillard's.
Yeah.
How is Dillard's doing so well compared to these other ones?
Dillard's has an excellent capital management approach. They were doing share buybacks, and now they're really returning capital to shareholders through dividends because their earnings per share. I saw the trailing earnings per share is higher than what the share price was pre-COVID. But like with a lot of these companies, gross margins got a huge tailwind from COVID. Whether it's consumers had stimulus dollars to spend, like Ulta Beauty is another one that's at all-time highs. That I think is a short. I think Ulta is an interesting short.
All right, well, I got to get you back on and talk about it. I got to get you back on and talk about the Ulta short because I actually I've loved Ulta for a while. Elf Beauty is another one in the cosmetic space that's been doing really well. But Rod, I got one last question for you because my 13-year-old Aaron would kick myself for not talking about this company because I get to in a work setting and make it professional. But I remember a while ago you were pretty bullish on PLBY. Stock hasn't been doing well. Have you changed your mind at all on PLBY?
I have. I wear a lot of egg on my face on that one, and I know you got to kick me off in like 60 seconds here, but the error with PLBY was a lack of a track record from an operator perspective. Management was private equity, is still private equity guys who are running this business. And in my opinion, they've failed at a lot of turns. And the governance structure is also one where the largest shareholder basically has it locked down. You need to get past a 2/3 supermajority to effectuate any board change. And we had a meaningful position. We've yet to disclose selling the position. It's been a learning experience for us, but thankfully for the firm, even with that huge headwind, we were able to have a successful 22, and we just got to take it as a learning. But given the management and governance issues, while I still think the asset base is deeply misappreciated and undervalued, it comes down to I don't know that management can unlock that value or management will return capital to shareholders. So I've begun to capitulate in my personal account, if you will. But that could have been a less painful lesson if I'd kind of gone into it with thinking more about governance, thinking more about risk than thinking about upside. And I think a lot of us, maybe who were high off of our winnings of 2020, 2021, didn't really think about those things. So I know you're booting me off, but tonight, if folks want to join in, we are hosting on Twitter Spaces Margin of Safety. It's a book by Seth Klarman. It's a value investor oriented book. We're going to have a book club discussion on our Twitter Spaces, our @Wook Capital handle. So that'll be at 8 o'clock Eastern tonight if folks want to tune in and listen in.
Awesome. I'll drop your Twitter in the chat. And yeah, Rod, I appreciate your ability to be candid talking about that. And I mean, it doesn't matter if you're, Warren Buffett or Carl Icahn, you're going to have a few losses in there. So always good to take some learning experiences from those.
Absolutely. It's a multi-year investing is a long journey. So you're going to win some, you're going to lose some. You just got to make sure when you lose, it doesn't blow you up. And if you win, it doesn't unmoor you.
Well, like I said, I appreciate you being open and honest about, like what goes into that. And I think if anything, it increases your credibility to me, and I'm sure it does for the audience as well. So
I'd love to be back and talk more about Wook, Aaron. I know you got to kick me off, but it's nice catching up. Hope to talk again soon.
Yeah, we'll do it. We'll do it soon. I promise. So I'll reach out right after the show. So enjoy the rest of your Tuesday. We'll chat soon. Guys, tune into the Twitter space. If you want to give Rod a follow, there's his Twitter in the chat. Thanks again, Rod.
Thanks, Aaron.